everyone, and thank you all for joining us during the Lytham Partners Fall 2023 Investor Conference. My name is Ben Shamsian, Vice President, Lytham Partners. Our next presentation comes from Mogo, ticker symbol MOGO on the NASDAQ. Presenting from the company is Greg Feller, President of Mogo. A copy of the slide presentation is available on your webcast screen. Today, I've asked the company to briefly run through the slide presentation as well, and then we will engage in a fireside chat. As a reminder, the company will be available for one-on-one virtual meetings. If you have not already signed up, please send me an email at shamsian@lythampartners.com, shamsian@lythampartners.com, or visit the Lytham Partners website, lythampartners.com/virtual, and click the one-on-one meeting request button. With that said, let me now turn the presentation over to Greg Feller, President and CFO of Mogo. Greg, please proceed.
Thanks, Ben, and thanks for having us at your conference. Excited to give investors an update on Mogo. Reminder, we will be covering forward-looking statements, so please read the safe harbor statement. Quick highlights of Mogo. For those that aren't familiar with us, we are one of Canada's leading Canadian fintechs, really pioneer in the Canadian market, now in our 20th year, with over 2 million members in Canada, with what we believe is a very differentiated and high-margin recurring revenue business model. We believe that this business model has shown its resilience during the challenging conditions over the last couple of years that a lot of fintechs have faced. We also, importantly, have exposure to $2.5 trillion global payments market for our payment processor subsidiary of Carta Worldwide. And we also give investors an interesting play on crypto, as we own just under 90 million shares of publicly traded WonderFi, which is Canada and actually North America's only fully regulated crypto exchange. We also have a strong balance sheet and with high insider ownership. Myself and our co-founders own approximately 15% of the outstanding shares. A quick snapshot, we're about $60 million revenue run rate. Again, all dollars here are Canadian dollars. We report and present in Canadian under IFRS. We did $2.5 billion of payment volume in the last quarter. Cash and investments, $52 million as of last reported date. Shares outstanding under 25 million shares. As Ben mentioned, we are listed on both NASDAQ and the TSX. So we really operate in three core areas. Wealth and credit being our consumer Canadian direct-to-consumer fintech business in Canada, where we are both a provider of digital wealth services to our customers as well as credit options. And I'll talk a little bit more of that. And then, as I mentioned, we also have our own payment processing subsidiary. This is really an international business, mostly a European business. So again, we give investors exposure to both the unique Canadian consumer financial services market, which really is dominated by a handful of banks. Canadian banks make about $100 billion of pre-tax profit a year, so a very profitable industry. And it's really been an oligopoly, and we believe one that's ripe for disruption. And then we have exposure to what we believe is a very attractive payments, global payments business through our Carta Worldwide business. On the wealth side, we effectively have three areas that we focus on. We have an active investing product called Mogo Trade, passive investing product called Moka, and then we also offer a B2B service to third-party wealth managers, leveraging some of the tools and infrastructure and services that we built for both Mogo Trade and Moka. This is an emerging business and a new growth area for us. What is the problem? Well, the problem today in Canada is that the typical Canadian consumer that has been reliant on the traditional banks for all of their financial needs, including savings, is not on track to retire with the adequate retirement amount. And in fact, the average Canadian's on track to retire with about $100,000, well below what's actually required to retire. And fundamentally it's broken and they need a different solution. What is broken? Well, there's over 2 trillion in mutual funds in Canada, charging 2% fees. And worse than the 2% fees, as we say, is these funds generally underperform the overall market, the S&P, by about 50%. So Canadians are being put into products that just don't perform nearly as well as the overall market. And for the privilege of that underperformance, they're being asked to charge very high fees. And that's the banks right now have about a $40 billion a year profit pool off of these mutual funds. That market, by the way, has mostly disappeared in the U.S., where very difficult for anybody to get those sort of fees off mutual funds, and more consumers going into the S&P. But we really haven't seen that in Canada yet. And we believe Mocha, through our Mocha product, we have a massive opportunity in the Canadian market. Just to give you a sense of how big of a problem this is, and how big of a differential it is from going into a 5% after fee mutual fund versus a 10% after fee S&P fund, which is effectively what through our Mocha product we offer. $100 a month by somebody at age 20 investing until they're 80 under that mutual fund would be worth about $430,000. That same $100 a month over a 6-year period would be worth about $3.8 million if they return the average of the S&P over the last 100 years. So this isn't 2x, this is multiples X. One actually allows you to retire, the other doesn't. And the reality is most Canadians, most consumers don't really understand this. And this is what we're looking to change in Canada. Alongside of our passive strategy product, we have an active strategy product, Mogo Trade. Our whole positioning here is that we are trying to educate the consumer that the reality is very few people can actively trade and make money. The average consumer, even the average fund manager, loses or dramatically underperforms the overall market. So we're trying to educate them. But if you are going to actively trade, which obviously a lot of people want to, you need to have an edge. And one of the strongest edges you can have is the lowest cost platform. And Mogo Trade is effectively the lowest cost trading platform in Canada. Zero commission, zero FX fees, and also a unique value prop in a zero carbon footprint. And I'll talk a little bit more about that. But effectively, we offset through active trading, we offset our customers' carbon footprint by planting trees in Canada. This becoming a bigger and bigger issue that millennials and increasingly Gen Z are focused on. In Canada, by the way, very few, really there's only one other free trading app in Canada. The banks control the majority of the stock trading apps in Canada, and they have not gone to free trading. So Mogo Trade is effectively the second free stock trading app in Canada. But unlike our competitor, we don't charge any FX fees, and they do. So ours, we really see as the lowest cost trading app in Canada. Then, as I mentioned, we also have an asset management piece to third-party wealth managers, where we sort of offer technology services as well as a regulatory and operational infrastructure for third-party managers to operate on our platform. And we believe that there's an increasing opportunity to attract those third-party managers on this platform. On the credit side, we've been extending credit to Canadians for over 20 years. This is in the subprime space, and this is really trying to serve those customers that, quite frankly, are being overcharged with NSF fees at the banks. An NSF fee in Canada can be upwards of $40. So if somebody writes a $100 check and that check bounces at the bank charges them $40. What is the effective APR of that? It's actually infinite because the bank's not lending you any money. They're just actually rejecting that payment and charging you $40. And a lot of those customers wind up going to payday lending companies that charge $15 per 100 for 2 weeks. And our product is a product that's trying to help them avoid that. Average loan size $1,700, average biweekly payment $30. And importantly, about 55% of our loan book has loan protection insurance that effectively covers their payment should they lose their job. So our loan portfolio, again, which we've been operating in Canada for 20 years, we believe performs extremely well through cycles. including global financial crisis, which Mogo operated through. And importantly, what investors need to understand is, unlike the prime books, where during economic downturns you can see loan losses or defaults and overall charge-off rates increase by 1.5 to 3 times. Generally, in our area, we see increases in the 20 to 30% range during volatile economic times. So a much more manageable increase that we see, and given the attractive yield of the portfolio and the 20-year history, something we've been able to manage through on a profitable basis through our loan book through multiple cycles. And then our third pillar being our payments business, Carta Worldwide, which we acquired in 2021. This is a payment processor, competes with the likes of Galileo, which is part of SoFi, Marqeta, an independent public company, Adyen, and Stripe. Mostly in Europe with a number of strong customers. In the last quarter, we saw payment volume up 51% year over year. So we see this as a big growth opportunity, long-term growth opportunity for Mogo internationally, and we're investing in that business right now. On our brand side, we are really building a unique, differentiated brand in the Canadian marketplace that not only stands for educating the consumer and low cost, but sustainability and transparency as well. And we think that's a highly differentiated brand versus the traditional players in the Canadian market. Turning to our financials, importantly, over the last year and a half, we've been focused on cost cutting and efficiencies, given the rising interest rates and obviously rising cost of capital. And although if you look back 6 quarters, we were negative 4 million of EBITDA. In the last quarter, we were just under 2 million of positive EBITDA, while seeing a very strong gross margin performance as well, and positive cash flow from operations in the last couple of quarters before investment in our loan book. And that was driven by a dramatic reduction in our OPEX. And in fact, if you added Q1 22 on this chart, you'd see that our OPEX has decreased about 50% from where we were in Q1 of 22. So we have been on a big efficiency initiative, while quite frankly maintaining pretty stable revenue. Overall revenues come off from about 17.3 million to 16 million in the latest quarter, but that was mostly driven by a couple of products that we actually exited. We exited a small product in France, and we also exited our crypto product and our prepaid card product, where they were really poor economics. So we made the decision to focus on our profitable areas. So we've seen very stable revenue performance during this period, which we think contrasts a lot to a lot of the other fintechs, and some fintechs have seen revenue drop 50 to 90% from peak levels. On the balance sheet side, we have, as of last quarter, 22 million of cash, 13.5 million in an investment portfolio, plus at the time we reported, our just under 90 million shares of WonderFi had a book value of about 16.7 million Canadian. So we have, not only do we have a fair amount of cash in our balance sheet to support any investments we're making, but we also have a number of other assets on our balance sheet. We believe we will have monetization opportunities over the next 12 to 18 months. And in addition, we've obviously got a business that is producing positive cash flow from operations before discretionary investments, including the loan book. So we believe we've got a sustainable business, a highly profitable business, and one with very attractive growth opportunities going forward. And so as we kind of look out into 2024, our goal is that we are targeting what we call the Rule of 40, and that is a combined adjusted EBITDA margin and revenue growth rate that total at least 40. And we are targeting to hit that at some point in 2024. So that means that we are going to be balancing our profitability as measured by adjusted EBITDA margin and growth investments where if we ramp up growth investments, that we expect that we're going to see commensurate increase in growth rates. And as I say, we're targeting to get to that rule of 40 at some point in 2024. We also are targeting to be at a 10 to 14 million EBITDA run rate by Q4 of this year. So we think we put the business in a very strong financial position with a strong balance sheet to start focusing back on growth. We're really kind of through the majority of our efficiency initiatives, so now we're focused back on growth as we turn our attention to 2024. We believe there is a massive multi-billion-dollar opportunity for us, both in the Canadian consumer, direct-to-consumer financial services area, as well as on the international payments space. So with that, the last comment I would just make, as we kind of think about the bigger opportunity in the Canadian consumer space, right now we're generating about $32 of ARPU per member per year. The average bank in Canada generates about $1,100 of ARPU per member per year. So massive TAM, massive opportunity for us to increase that $32. And obviously, we still believe there's a massive opportunity for us to increase that 2 million member base well in excess of where we are today. So again, we believe there's a multi-billion-dollar opportunity for Mogo, both in the Canadian market as well as in the broader international payments market. And then with that, I'll just, Ben, turn it over to you to see if there's any questions.
All right, thanks. Thanks very much for that overview. I just want to delve into a couple of topics. Let's talk about the wealth management. You talked about it a little bit in your presentation. Can you delve a little bit more on how Mogo is disrupting the well-established $2 trillion mutual fund market in Canada? Help the U.S. investor understand that dynamic.
So, yeah, I mean, I think what we are trying to expose is, quite frankly, what Buffett's been talking about for years, which is the racket that is traditional wealth management and mutual funds. And that is that 95% of the wealth managers and funds don't outperform. In fact, they significantly underperform the overall S&P. But the industry is set up to not put investors in that because they don't make any money on that. As I said, on the $2 trillion sitting in mutual funds today in Canada, the banks are pulling out about $40 billion a year in profit. So they have every incentive in the world to keep those investors in those products. But the reality is those investors are generating significantly inferior returns. As I said, the average mutual fund is about half of the average of about the S&P. So we're really getting out there with a low-cost platform, educating the consumer, and really focused on the next generation. We believe in a world of AI, social media, et cetera, that racket is not going to continue. That investors are smarter than that, and we think the next generation is where we're focused on educating them, getting them up to speed. And with our pricing, our disruptive pricing, quite frankly, the big banks have no incentive to compete with us here because they'd be taking their $40 billion pool and slashing it by over 90%. That's $40 billion profit pool. So they have really no incentive to compete with us here. And we're getting out there telling the story. We think this is a product which we're going to start marketing as we head into 2024, the combined wealth platform. We've been doing a lot of product investment over the last couple of years, and it's now, we believe, ready for prime time. We're going to be heavily social influencer based on this because this message of really talking about how investors are being cheated out of the opportunity to save for the future by high fees, low performing funds is something that resonates with the average influencer. Then you layer on the sustainability piece on it, which nobody else in Canada is doing it. And we think we have a very unique, compelling value proposition, especially for that next generation of Canadians. And our model is built so that we can be profitable on a very low margin. And in fact, our overall wealth platform today on a standalone basis is positive contribution. So we already have positive contribution from the wealth business at our current scale. We have about 300 million of AUM, but obviously it's a multi-trillion-dollar opportunity in the Canadian market, and one that, as it scales, obviously we believe can generate significant returns for our shareholders.
Got it. You talked about EBITDA growth, targeting annual EBITDA run rate of 10 to 14 million, exiting 2023. What are some steps that you've taken to get to that position and to achieve these goals?
Well, we've really been focused on maintaining stability in our revenue while reducing our overall costs. As I said, exiting unprofitable products. So that was step number one. Step number two is getting really focused on where we're doing our development efforts. So like all companies, when cost of capital is close to zero, we had multiple investments going in multiple areas, and we have really skinnied that down now to really our kind of three core focus areas of wealth, credit, and payments. So we've got a lot more discipline around that. We've driven what we call a high performance culture through the organization at Mogo, which is really increasing productivity with fewer people. So we're doing more with fewer people. So our productivity's actually increased with the high performance culture that we've been driving over the last 6 quarters or so. So I would say it's a combination of all of those things. And as we look into 2024, again, our focus is the rule of 40. Rather than us explicitly targeting a certain EBITDA in 24, we're really targeting getting to that rule of 40. And that means depending on where that EBITDA margin is, we'll have to have a higher or lower growth rate. And if that EBITDA margin is lower, we'll have to have a higher growth rate. If that EBITDA margin is higher, we could hit that 40 with a lower growth rate. But our goal is to stay EBITDA positive, number one, and then hit that overall combined EBITDA margin and growth rate of 40 at some point in 2024.
Okay, great. I want to talk about your balance sheet. It's quite strong, but I think somewhat misunderstood, as there's some quite few pieces to it. You have the Fortress facility, you have the WonderFi piece, you have some assets in various privately held companies. Can you sort of just parse some of those pieces out and simplify that for investors here?
Yeah, sure. So, look, on the asset side, as I mentioned, we have about 22 million of cash. We have a private portfolio of investments of about 13 million, which actually includes some public companies, but 85% of the private investments, private companies like Hootsuite in Canada, Balloonant in Canada, and a few others. Most of which we believe are strong companies. That at some point there'll be a monetization opportunity for us. But the ability to monetize those assets really is less in our control and more dictated by the timing of where those companies go in their capital journey. But then we've got just under 90 million shares in publicly traded WonderFi on the TSX. They're actually in the middle of trying to get listed on NASDAQ. They, again, are the only fully regulated crypto exchange in Canada. Canada, unlike the US, has laid out a clear regulatory path for crypto and has effectively allowed certain crypto exchanges that adhere to the rules and have a certain amount of regulatory capital to be fully regulated, similar to broker-dealers in Canada. And WonderFi is the first and right now only to get that fully regulated status in Canada. And they've been a bit of a consolidator in the industry. So, we continue to believe there's a big opportunity there. Obviously, with what's going on in the US and the world, there's been increased focus around Bitcoin as that sort of digital gold store value. So I think there's a lot of dynamics happening that make that overall market attractive. But effectively, investors in Mogo have, in my mind, an option on that with our stake in WonderFi. And at some point, we'll have opportunities to monetize that stake, which would allow us to put more capital in the balance sheet in a non-dilutive way. And then on the debt side, we do have, as you mentioned, a credit facility with Fortress. That facility is more than offset by our loan book. So it directly funds the loan book. And we've been with Fortress now for almost 10 years. They've been a great partner of ours. As I say, we've been a lender in Canada for 20 years, so a product that we know extremely well. We also have some debentures on our balance sheet, but the attractiveness of those debentures for us is really no covenants, and we have the ability to extend those maturities, which we've been doing now for 20 years. So they've kind of acted like a perpetual preferred, and given us a lot of flexibility on the capital side. So I think you're right. A lot of people, that's sort of misunderstood, but we think we're in a strong position right now overall with our balance sheet as it currently stands.
All right. We're coming to the end of our time here. Greg, thanks very much for your time today. We greatly appreciate it. Again, to anyone out there who has not already signed up for a one-on-one, please send me an email at shamsian@lythampartners.com, SHAMSIAN@lythampartners.com, or visit lythampartners.com/virtual and click the one-on-one meeting request button. With that said, we hope you all have a good rest of the day, and thank you for your time.